I think we're setting up very close to a situation like 2001 to 2007, where tech underperformed. We're not going to crash like we did back then because they actually have earnings power, but underperformed. And as some of these groups outperform as the dollar weakens.
Hello and welcome to our latest Money Show Money Masters podcast segment. I'm Mike Larson, editor-in-chief at MoneyShow. 2024 has been a strong year for the stock market. We're seeing a lot more volatility in August and September to date. We have a huge list of potential market catalysts right around the corner. That includes the first likely Federal Reserve interest rate cut in 4+ years, and of course, the upcoming presidential election. Joining me to cut through the clutter and give you some actionable opinions about what is likely to happen is Tom Hayes. Tom is founder, chairman, and managing member of Great Hill Capital, as well as the man behind the informative and entertaining market commentary site Hedge Fund Tips. Tom, how are you?
I'm doing great. Good to be with you, Mike.
Yeah, I'm glad to have you here. I mean, geez, a lot going on in the market. So I guess I kind of have to start with the most obvious question, right? Is September going to be one of those moments where we all want to run and hide, or do you think this seasonally weak period for markets talk is a little bit overblown?
You know, it's interesting. When everyone's looking for a correction is when you usually don't get it. You know, we've been of the view that it could get a little choppy in late September and early October. I think the potential surprise here, Mike, is that the jobs report should come in a fashion on Friday that will cement the Fed doing obviously the 25 basis points and maybe 50 basis points, but more likely 25, no matter how bad the jobs report is on Friday. And we've got two coincident factors. Number one is the election year seasonality. If you look back to World War II, it tends to actually be, markets tend to be strong into mid-September, not September 1st, mid-September. That doesn't mean it's going to work exactly that way this year. But the other thing that we notice is when a Fed starts the easing cycle, the first cut has a high propensity to be a buy the rumor, sell the news. So our base case is actually that we start to see some strength into that first cut. So, you know, maybe yesterday and today being a one-off, the short-term volatility, we get the jobs report, people start to look forward to the cut, and maybe we even touch, you know, we did with the Dow, or relook at near new highs on the S&P, and then we move into that normal pre-election jitters from late September through the end of October, which will be an opportunity to buy into a year-end rally that is fostered by a hopeful gridlock outcome, irrespective of who's elected. Not having one party with absolute control is the key for the stock market.
Got it. Well, let's talk a little bit about the Fed and kind of the economic news. I mean, as we're speaking, we just got a pretty lousy looking JOLTS report. You know, we won't have the NFP by the time this airs, but we've seen some squishier, softer numbers, not terribly recessionary, in my opinion, of late. So how do you think the Fed reacts? What do you see them doing again in September, and maybe as we roll into the final couple of meetings here in 2024?
Yeah, Jay Powell has a history of not liking to shock markets. I think he learned that early on in December of 2018 when he said autopilot. And by Christmas Eve, everyone was wondering if the stock market was going to fall through the floor. It fell something like 19%, like overnight. I was at Disneyland looking at myself. I'm like, what the hell is he doing? And fortunately, Mnuchin stepped in and got the banks together and recovered everything. So since then, he tends to avoid major surprises, and on that basis, I think he's going to do 25, even if the jobs report is weak. And from there, we could see the market's pricing in 100 this year. I don't know. You know, that would kind of concern me in the sense that if they do a 50 cut, maybe the economy is a little worse than everyone expects. Maybe it's not a soft landing. So our base case is actually more conservative, 50 to 75. I think 75 probably gets done 25, 25, 25. Yep. And then we see where it is in 2025.
Got it. One of the things that obviously I follow your work at Hedge Fund Tips. It's fantastic. Everybody who's watching this, please make sure you sign up for some of that commentary because it's very insightful and enjoyable. One thing I know you've been talking about there and elsewhere is the rotation that we've seen in this market for the last couple of months, right? I mean, it was an all tech all the time market for a while. Since July, that's been changing. What do you think is going on there, and what do you think that means going forward?
I think it's very, very healthy. The market is broadening out. And it's not just some hope. Like we've had some fake outs in the past. This time it's actually backstopped and substantiated by the trends in earnings. You had the Magnificent Seven earnings growth in the first quarter of this year was 50%. That's dropping down to 18 to 20% by fourth quarter of this year. And year on year, it'll go from 30% this year to 18% next year. At the same time, the Unmagnificent 493 in the first half of this year had negative earnings growth. So when people say, well, why are only 7 stocks performing? Because only 7 stocks have meaningful enough earnings growth to perform. That is changing. That's now inflecting to positive earnings growth. And that's why you're starting to see the broadening. That's why you're starting to see the movement under the surface. Small caps, for instance, expected to grow 7% earnings growth this year. How about 37% earnings growth next year? And that is also in line with the first 6 and 12 months after a Fed cut. Value outperforms growth in the first 6 months, and small caps outperform large caps by over 11 percentage points in the first 12 months after the first cut from the Federal Reserve.
That's some great insights there. And I wanted to ask you, while we're on that subject, within sort of the small cap space or some of the non-tech sectors, what looks particularly attractive to you? I mean, is it financials? Is it industrial? Something else that you're watching?
It's across the board. We specialize in turnarounds. My nickname is kind of Turnaround Tom. One company that's not a small cap, it's not a dividend pair. The groups that tend to outperform after the first cut, we've got a weakening dollar, we got lower rates. So that means emerging markets should do better. It means small caps should do better. It means dividend payers should do better. And it means value should do better. And I think one of the stocks that has become a value stock is called that we own is called PayPal, and we own it lower from these levels. It's had a recent move, but we think just getting started. And the name of the game there is 490 some odd users around the world. But more than that, why is the stock down? Why did the stock fall 80% from the COVID highs? Is because margins were compressing, and they got this new CEO named Alex Chris. He came from Intuit. He ran 50% of the revenues there, the small business division. While he was there in 10 years, the stock was a 38 bagger. He's going to apply some of those principles to PayPal. And the first thing that he's focused on is something called fast lane. So you have a business at the Money Show. And what if I could tell you that instead of having 50% conversion when people check out to buy a ticket, it goes to 80% conversion, and it reduces the amount of time that they're on the site and closes the conversion that much faster. Would you be willing to pay Braintree or PayPal 2.2% take rate versus 2.0% take rate if your conversion went from 50 to 80%? Would that make sense for you as a business person?
Yeah, sounds exciting.
Complete no-brainer. And it's gotten so good that it's not even just PayPal using it now. Their competitors like Aiden, which is one of the biggest payment processors in Europe, is now licensing the Fastlane checkout from PayPal. Fiserv, which is a multi-billion-dollar company, is licensing that service from PayPal. So what's happening? Margins are reaccelerating. And he came in and cleared the deck. He's barely coming on 1 year. And, he basically took expectations down. He said, we're going to do $5 billion of free cash flow. We'll buy back $5 billion of stock. Well, he just came out this quarter and has said, that $5 billion, I got that wrong. We're actually going to generate $6 billion of free cash flow this year. And we're going to buy $6 billion worth of stock. Then you got this other business called Venmo, which is basically the Kleenex of peer-to-peer payments that's growing like a weed. They've got a Venmo for teens that's growing like a weed, and there's a lot to do there. So it's really just the beginning. So some of these fallen angels are really a tremendous opportunity here.
I love that you brought up the Turnaround Tom nickname. I'm going to get to that in a second towards the end, but I wanted to ask first, you've been a proponent of some looking outside of U.S. borders at some of the cheaper stocks you can find around the world, even in a place like China, which had fallen out of favor for a long time. Are we at the point where those types of markets are going to play catch up here? If so, why? And what would you do about it?
Yeah. So two things. 100% dollars weakening, yields are coming down. That is a magic formula for emerging markets. I think we're setting up very close to a situation like 2001 to 2007, where tech underperformed. We're not going to crash like we did back then because they actually have earnings power, but underperformed. And some of these groups outperform as the dollar weakens. So China, we want exposure. And look, we've been bagged in this Alibaba for a year and a half. It's been dead money, completely done nothing. But I think the time is now. And Alibaba is a proxy for emerging markets, but more than that, a proxy for China. It's the national champion. And something very important just happened. The shareholders voted on August 22nd to approve a dual primary listing in Hong Kong. That enables it to join the Southbound Connect on September 9th. What does that mean? It means for the first time ever, mainland China investors, and there are 220 million of them, they anticipate about 180 million as a potential market to buy Alibaba stock, will be able to buy Alibaba stock for the first time ever starting September 9th. What's more important than that is that Alibaba's got about $80 billion of cash on their balance sheet. And rather than, they couldn't get that cash out of China to do buybacks, so they would have to issue non-dilutive convertible stock in order to get US dollars to buy the stock back, even though they had $80 billion sitting at home. They will now be able to buy back stock through the Southbound Connect. And you see just in the last few days since that dual primary listing was approved, that they're reporting how much stock that they're buying back. And we're going to see that accelerate. So I think, look, everyone feels that China's uninvestable. But if you look at the Hang Seng for the last 20 years, you have these huge corrections every 2 to 4 years. And the bigger the correction, the longer it takes. Usually takes about 2 years to build the base. But when it turns and it starts to move up, it tends to be parabolic. And, you got to keep in mind through all the noise, the country's still growing at 5% GDP. And here we are, American exceptionalism, no question about it, but we're growing at 2.5%. So there's opportunity there. They will recover. And I think demographically speaking, they've got another huge parabolic run before maybe they do run out of time 3 to 5 years out, like Japan did in the late 80s, because they didn't make enough babies for so long. But for now, they've got a huge portion of their population age 34, and their spending should increase and peak out at around age 40.
Got it. Tom, you're going to be joining us for the 24 Money Show Masters Symposium in Sarasota this December. We talked about this sort of turnaround approach. I just want to know, when it comes to methodology, why do you find that style of investing so attractive? And what do you think people who are looking to be value investors or turnaround investors need to know when it comes to pointers or advice?
Well, number one, a stock that falls 90% can fall another 50% before you get a 5-bagger. So it's there's something to be said there. But what we like is we're not predict the next great thing people. We are buying durable business that have been around through many cycles and have had multiple turnaround situations and have proven they have a durable moat. So even when the stock's down 60 or 80% or whatever it happens to be, when we're getting involved, we're looking and we're saying, okay, well, the free cash flow and the revenues are kind of holding in there. Or in some cases, they might be down modestly. They're not down 80%, that I can assure you. Your revenues are usually flat or growing, and free cash flow is usually positive. And then you get some catalyst with a new CEO that has talent to take this beautiful legacy franchise that has been through multiple cycles over decades and turn it back into something great. And we like it because the margin of safety is much greater once we have comfort with the balance sheet, et cetera, that we can make a double or triple in a handful of years versus business that's already up quite a bit. We had talked about, you may have caught our note in June of this year when we said Nvidia was the new pain trade. You can look it up on the website. It was like June 22nd. That day, it opened at 136. It went up to 140 against us and has since fallen about 30-40%. Because it's a great business, but at $3.2 trillion valuation, when you have a total GDP of 28 trillion and an expected growth rate from the sell side of 40% a year, what they're basically trying to convince you is that it's going to be half of GDP in 4 years, which is absolutely makes no sense if you're interested and believe in something called math. So, so those are the type of things that we avoid. And other things that we can have a sense of certainty 2-3 years out, we can make a double or triple. If it's a smaller business, sometimes we can make a multi-bagger.
Got it. Well, just one last question, I guess. Beyond what we've talked about here, any other sneak peeks or tidbits about what you think you might be talking about in Sarasota? I know December's still a few months off, so it's a little bit tough. Who knows what the market will do between now and then?
All I can tell you is in the Unmagnificent 493, there are tremendous opportunities still that have been created by a once-in-a-100-year event called COVID. And these are durable, multi-decade franchises. So we're going to talk about a few of our ideas for 2025. We're very excited about that. We're going to talk about our general market outlook, and we're going to have a lot of fun.
Great. Well, Tom, listen, thank you so much for your advice and your insights here. Viewers, if you're watching and you want to learn more from Tom, he is going to be joining us at that Money Show Master Symposium in Sarasota. It runs December 5th to 7th at the Hyatt Regency Sarasota here in sunny Southwest Florida. If you've been to this part of the country in December, you know how great the weather is going to be. It's going to be a wonderful time. Enjoy the outside, enjoy the knowledge you're going to get inside, and learn from experts like Tom. So click the link below, look at the description if you need some more details. And Tom, I look forward to seeing you there in a couple of months.
Thanks, Mike. And one final caveat, opinion, not advice. Thanks so much for having me.
Got it. Sounds good. Take care, Tom.
Bye-bye.